What's up, YouTube? The last few days of 2024, sending it out here in a tent in the wilderness because you can do investing anywhere on the planet. All you need is just a decent internet connection for you to make some cash. And so today we're going to run through 10 quick charts on what I think is happening in the markets and what I think will happen in the next couple of weeks and how I'm positioning myself. So if we look at the first chart, it's basically the S&P 500, and everybody's been watching this rising wedge pattern, and we broke it, right? We had that pretty nasty drop recently, and yes, we've recovered. And what's interesting is we've kind of hit the bottom trend line of this rising wedge. And there's a couple of things going on here that I'm watching very carefully, because normally, if there is a fake out, meaning it breaks down but it really wants to go up, this wouldn't happen. We wouldn't have a hit and go down further. But that's exactly what's going on. So that is a cautionary signal that there may be more downside to come before perhaps we even make a new all-time high. That's something we'll let the market show us. But as of now, I'm looking at a potential further downside because, if this was a head fake to trap the bears, we shouldn't have stalled at the bottom rising wedge line and should have just shot up. And usually when there is a head fake, the shoot to the other direction is that much more pronounced. And we didn't get that. So this is why I'm looking into a position where if the market goes down, I'll make more money. Now, I'm not shorting the market. Even though I think it might in the short run go down before making new all-time highs as we complete the blow off top, but I'm going long on volatility, and I'll explain to you why I put that trade on. Now, the one thing that should be spooking everybody is what is going on in the bond market, which basically has been rising, right? Yields on the U.S. Treasury have just, inexplicably been going up, even as the Fed started cutting rates a couple of months ago. And now we're at 4.6 and 4.8 for the 10 and 30. It's not impossible to hit 5, right? And if we hit 5, bad things will happen. Let's take a look at what has been going on. And if you look at this chart, look, the Fed has been cutting 100 basis points on the Fed funds rate, yet the yield on the 10-year has gone up 100 basis points, which is, actually, that's never happened in history, right? Not to this degree. This is a one-to-one correlation in the opposite direction. And here's what I think. Look, the stock market is like a bunch of cowboys. It's the rowdy people who want to go gambling and do meme stocks and, meme coins and all that stuff, right? Whereas the bond market is more like, the reserved people, right? The professionals, the ones in black suits, the ones, who, operate in the background with large pools of cash. And it is a bigger market than this equity market, the bond market is. And between the two, somebody's going to be wrong and right at this stage, right? Because the stock market's been going up while the yields have been going up. One of the two is going to revert to, the norm. And I wouldn't put my money on the cowboys, right? I put my money on the serious professionals wearing the dark suits. And they've been clearly signaling to the Fed that they don't believe in what the Fed is doing and cutting rates, and that inflation, given the policies that are coming down the pipeline with the new administration and with what's going around the world, is likely to be sticky and in fact possibly go up, right? And so this is going to resolve one way or another. My money is not on the stock market. My money is on the smart money in the bond market. And I do think we're going to see a resolution. This can't continue forever, right? This opposite direction thing can't continue forever. It's going to resolve soon, one way or another. I think it's going to resolve within the next month in January. And I think that resolution is also going to be around the time when we're going to make finally the top, right, for this multi-year bull run and usher in a bear market and essentially a recession afterwards. So this is going to end, right? This is not going to continue for long. And if you look at what is being impacted by all this, it's actually the mortgage rates, because those are tied to the U.S. Treasury, right? And when you look at what's been going on, is the Fed started cutting interest rates in August, And look at what happened to mortgage rates. I mean, we spiked to the highest it's ever been since 2000, right? So 20 plus years of history has been erased in just like in just a few years we've gone up so high in the mortgage rate that, I mean, this is basically causing all kinds of angst in the housing market. And what's going on in the housing market is you've basically had a drop. It's frozen, right? Nobody wants to buy at such high stratospheric housing prices with, at the same time, super high mortgage rate interests. So applications has just gone down, right? Like lowest since 1995. That's like 30 years, right? Nobody's buying, right? The housing market is essentially frozen. It's like a Mexican like standoff. Like everybody's pointing guns at each other and nobody wants to fire, so you're just all frozen and you don't know what to do. But that's what's going on in the housing market. And again, that too will resolve one way or another, right? There will be a resolution to this. Either housing prices will collapse or mortgage interest rates will collapse. One or the other has to happen, because otherwise the housing market can't remain frozen forever and ever with no transactions going on. That's not going to happen, right? So if we move on to the next chart here is like, this just shows you. So the actual pending home sales index is back down to levels that we haven't seen in many, many decades. Again, and this is an indication that nobody's buying and selling houses. They're just sitting there, right? And everybody's, again, in this Mexican standoff, just with the guns drawn, hoping, that somebody else is going to pull the trigger first. And we'll also see a resolution to that. So there's a bunch of things that are out of whack in the system that I'm showing you that are stretched to historic limits. And we're talking about 3-4 decades worth of, um, limits that haven't been hit. And when these things resolve, like, because there will always be a mean reversion or reversion to the mean, right? These things, like a rubber band, can't stay stretched like in opposite directions forever. The further they're stretched for the longer time, the more violent that mean reversion will be. And I'm telling you, these are pretty stretched indicators that is telling you, like the market is telling you, that there will be a pretty severe mean reversion. That's just, you don't even have to talk about economics. That's just physics, right? And so, going back to the stock market, you will see that. And so this is the equal weighted S&P 500 over the S&P, meaning, how much of the rise in S&P is it concentrated on just the Mag 7 or a few stocks? And you'll see that, you got to go back to 2009 when it was this concentrated, right? Meaning, equal weighted S&P is not doing well, right? Unlike the S&P, which is heavily focused on just a handful of stocks. And we're now, again, we hit this, and that's when we had that little like down. And so we've hit it again. And that means the boat that we're all in, everybody's concentrated into one side of the boat, right? And the boat's like tilted sideways. And that's why, when you correct over, the boat starts like having more and more violent swings as you try to balance it, and it gets crazier and crazier. And eventually what's going to happen is the boat, may overturn. And it's exactly that overturning that I'm positioning myself off, while at the same time making money as we reach all-time highs. I know it sounds counterintuitive, but I'm positioning myself for the boat overturning, but at the same time understanding that we may hit new all-time highs. So, my positions are in and out in a nimble fashion to take advantage of going up, but at the same time being in position if that sudden capsizing does occur. Because when it happens, you're either in it or you're not in it, right? There's not going to be some like warning for you to see it. Like, it's just going to happen. So you need to be in it before it happens. And that's a whole, that's the trick, right? How do you be in it while still be making money on the way up? Another signal to look at here is, this chart's basically telling you, how expensive the stock market is with the PE ratio and what happens in subsequent 10-year returns, right? And so obviously when the PE ratio starts going really high, meaning the stock market's really expensive, the returns start going down, right? And when it's cheap, you have good returns in 10 years, right? So what's going on here is we're at a very expensive very expensive stock market, and you can't expect a return to come back when it's already so expensive, even with all the inflation and money printing, right? Because that has been happening in the past 4 or 5 decades. So this incorporates the money printing, right? Even with a 10-year period, because we're talking about 50 years um, over time. So we're at this stage where it's overpriced. Don't be expecting like the type of returns we've been getting the past few decades. That's a yesteryears. That's not coming back until we reset ourselves with the incoming depression and recession and bear market. And let's hope it's not a depression, but you never say never, right? This chart now is an interesting one. This one tells you this is the cost of going long on stock markets and the cost of margin to lever up, right? So what you're seeing here is the cost to lever up has collapsed, basically, right? It has collapsed, meaning there's so much supply of it, right? Because everybody's buying it, meaning everybody again is tilted to one side of the equation, which is levered long stock. And this is one way to see that. It is telling you that the cost or the money, the margin you have to pay for margin to go long on the equity is collapsed, right? Everybody's doing it. So there's supply and demand, right? And we're there. Look, I mean, this is a crazy thing, right? This is a crazy collapse in the cost to go levered long on the stock market. That caught my eye when I saw this chart. The other thing going on that we should keep an eye on, and this is not like a really great indicator, like this won't really tell you one thing or another like some of the other ones I've shown you, but this is a good supplementary indicator, and that's telling you that the corporate insiders aren't buying, right? Like lowest level in, again, decades. They're just not buying their own stock, right? And why? This is averaged out over all the companies. And one could make the case that it's year end or whatever, but there's been many year ends, right? Like, why is it this low? Well, it's just basically they're protecting themselves, right? They don't see the upside in terms of the price of risk at this stage, or how expensive the stock market is, and that's something I agree with. So, how does it all translate into what's going on with what I'm doing? So, in the last video I told you I got out of my UVXY with a good profit, and I actually, in one of the comments, I said I went actually the opposite. And shorted volatility through SVXY. And, I was in that trade and I got out of that trade. And so I was able to actually ride this up and ride this back down for a decent profit. And like I said, that took longer than I thought it would. It took over a couple of months actually, to pocket that profit, but that's okay. You're not going to make it every month, right? It's not like a timetable that sets you. You see, the thing is, you don't try to time the market. What you do is you try to have a price projection, and then you let the time to get to that price target work its way out, right? A lot of people try to time the market. In my younger years, I used to do that, thinking I knew I could tell the future, and that's where you go broke, basically. And that's what I do not do, and I don't recommend anybody. By the way, everything I say here is just for entertainment purposes, right? This is not investing advice. Go see a real legal investment advisor for that stuff. But for entertainment, yeah, no, I don't time the market. I put price projections, and I let the market work its way to those price projections in its own time. That's why the last trades I had took a little longer. So based on that, I'm now again back long into UVXY, meaning I'm long volatility. And the reason is because, as in the beginning of the video, I showed you that this doesn't look good to me. If we did have a false breakdown to do a bear trap and then shoot up to the moon, this shouldn't have happened. We should have just shot up, because false breakdowns usually lead to really, really strong moves in the opposite direction, either up or down. In this case, it should have gone really strong up if that was a fake out for the bears, and it didn't, right? And so I do think that in the short term, we're probably looking at more downside, or that's the way I'm positioned with long volatility, at which point we may then finally, put in some intermediate bottom and try and make our way up to a new all-time high in January, right? Before, where probably the mean reversions I was talking to you about, the bond market, will work its way back. And I don't know. I don't know if that's going to happen, and I'm not trying to predict that, right? But what I am trying to do is be positioned so that if that snapback happens, and again, you have to be in it. So being in UVXY or long volatility, if we do have this, it just drops. I'm there, right? I'm there. And if it doesn't, well, we might just still have a short term, drop because of what I described with this price action behavior, which I'll still also profit. And if we then shoot back up, I'll switch and go long to ride up to the new all-time highs, right? But when I'm long, I try to keep those positions short because I do want to be positioned long volatility or short the market so that I'm in it when and if that hammer drops and we get finally the beginnings of the bear market. And so let's see how it goes. You know, we're about to end 2024, so I just want to wish anybody watching this. I just want to thank you first for watching and joining me on this journey. This journey is all about being there to catch the big drop, right? But at the same time, make those incremental returns as the market continues to go up. And I hope everybody has a blessed, happy 2025. And I'll see you next year. Peace out.